So very welcome here, everybody. It's a quarter past to this international lecture series. Very welcome to everybody online as well. We have with us Brett Christophers from Uppsala University, the Institute for Housing and Urban Research. Very welcome to us. You will talk for maybe 50 minutes or so, you said. Brett has written several books about marketization, markets. Most recently, the book The Price is Wrong, Why Capitalism Won't Save the Planet. And I take it that this is the book that you will depart from here today. So thank you very much.
Thank you. Thanks for having me. And it's lovely to be here. It's my first time in Linköping, actually. So it's very nice to be here on this beautiful day. Thanks for coming along to listen and hopefully engage and ask questions and make objections if you want to make objections as well. As Simon said, I'm gonna talk about the most recent book that I wrote, which he mentioned, The Price is Wrong. And I'm going to try my best in it will be around 45, 50 minutes, I guess, to essentially give as good an overview as I can of, I suppose, the main themes of the book and the main arguments of the book. I'll begin by saying right away that the book is quite long, and it's quite, some of it's quite complex. So a lot of the book gets into the weeds of things like electricity markets and energy finance and things like that. I'm not going to, in what I do today, I'm not going to get into any of the kind of technical stuff. I'm going to try and kind of abstract from that and keep it at a relatively high level of accessibility. But I'm more than happy to get into any of the technical stuff if people want to ask questions about any of that. If you're interested in any of those things, I'm more than happy to talk about it. So I think the obvious place to start is just to say a little bit about what the book in very general terms is about. So while it has a very kind of grand title or at least subtitle about why capitalism won't save the planet, it's actually quite a specific book. It's quite a targeted book. It's a book specifically about electricity. And it's a book specifically about the challenges of decarbonizing electricity generation. And it's a book about electricity decarbonisation globally. So it's not a book about Sweden. It's not a book about North America. It's not a book about India. It's a book that tries to make some arguments and observations about decarbonisation of electricity at a very broad global scale, which obviously brings with it certain challenges, but also I think raises certain opportunities in terms of what you can say. So why electricity? Like why talk about electricity in the first place, and why talk about electricity specifically in the context of climate change, which is what the book does. Like I think many of the things I'm going to say today, some of what I say now is going to be obvious to some of you. It might even be obvious to many of you, but my guess is that there'll be some people in the room for whom it might not be obvious. So I apologize if any of what I say is completely obvious to you already, but it might not be to everyone. So the first reason, and I think there are two connected reasons for talking about electricity generation in the context of climate change. So the first of those is simply that electricity generation is right at the heart of the climate problem as we have it today. So if you think about the totality of anthropogenic greenhouse gas emissions, roughly about 3/4 of those emissions are carbon dioxide. And then if you focus in on those carbon dioxide emissions, roughly 75% again of those come from the combustion of fossil fuels, so oil, gas, and coal, which is obviously why we talk so much about fossil fuels when we talk about climate change. They are the heart of the problem, if not the totality of the problem. And then if we focus in again on those carbon dioxide emissions from burning fossil fuels, the biggest single component of that is electricity generation globally. So there are obviously lots of other things, transportation, industrial processes, and so on. But the biggest component of it is electricity generation. So electricity is kind of right at the heart of the climate problem as we have it. And then, no less importantly than that, electricity is also important because electricity is seen as the way of paradoxically in a way, is seen as the best way of decarbonizing much of the rest of the economy and society through processes of electrification. So the basic argument is that for things like road transportation, so cars and trucks, the best way to decarbonize them is not to switch to another type of fuel, but to switch to batteries, which are powered by renewable electricity. And so electricity is this kind of really weird thing in the sense that it's both the problem and the perceived solution. So electricity generation is causing the problem, but the way out of the problem is by electrifying everything and then generating that electricity through zero or low carbon sources. And so if you think about the problem in very simplistic terms, electricity is important now, but it's going to get even more important going forward because we're going to be using and generating much more electricity if we do indeed electrify all those other things as rapidly as we hope to do. So that's why electricity is so important. It's both the main problem, but also the main solution, which begs the question, given its importance, of how we are currently doing on decarbonising electricity. And by we, I mean at the global scale. And this is one of these, what I like to say about this is one of these classic cases where the answer that you give to that question or the way you kind of perceive current progress tends to depend very much on whether you're like a glass half full or a glass half empty person. If you're a glass half full person, and there are plenty of commentators on climate out there that tend to be that way, what you tend to do is you'd look at graphs showing the amount of investment in, say, solar and wind power in recent times, the amount of electricity that's being generated from renewables, and you'd say, well, look, those charts are curving sharply upwards. We're obviously heading in the right direction. We're investing much more money in renewables. We're generating much more renewable electricity. We've kind of got this. We're on the right track. Everything's hunky-dory. Whereas if you're a glass half empty person, you'll say, okay, let's forget about renewables for 1 second and let's focus on electricity generation from burning fossil fuels, which is primarily coal and natural gas. There's not much oil used in electricity generation anymore. And what you find there is that despite all that recent historic growth in renewables, we are still every single year generating more and more electricity from burning fossil fuels. Very optimistic forecasters have been saying for at least the last 5 years or so that this will be the year that electricity generation from burning coal and gas peaks. They said that in 2020, 21, 22, 23, 24. They said it last year, and it still keeps on not happening. So the bottom line is that all of that growth that has occurred so far in electricity generation from renewables has been purely supplemental to, rather than substitutive of, electricity generation from fossil fuels. It's on top rather than substituting for it, which is why the whole idea of the energy transition, which we hear about all the time, obviously, is kind of a myth so far. There's no energy transition going on yet. There's a process of energy addition going on rather than a process of energy transition, whereas, of course, it's an energy transition that we actually need. So basically, globally, we are absolutely clearly failing insofar as all of that renewables growth is supplemental. And frankly, even when electricity generation from fossil fuels peaks, which it will, hopefully, at some time in the next few years, if it then starts only to go down very slowly, we're still essentially failing because it needs to go down very, very far and very, very fast. Okay, one other thing I want to say about the question of progress on electricity decarbonisation is to make, again, what I think is a simple point, but it's an important one, which is to say that there's obviously enormous regional variance on the topic of electricity decarbonisation. So if you think about a country like Sweden, for example, Sweden, when it started, taking climate questions seriously, was in many ways, fortuitous position that it didn't need to decarbonise its electricity generation. As early as the 1990s, electricity generation in Sweden was already essentially decarbonised. It was nuclear and it was hydro. It's been many decades since fossil fuels played any significant part in electricity generation in Sweden. So Sweden didn't even really have this challenge of decarbonising electricity generation. And then if you kind of look at it at the other end of the spectrum, there are, however, countries around the world where still in excess of 80 or 90% of electricity generation is still from burning coal or natural gas. Some examples of countries that are above 90% would be South Africa is above 90%. Pakistan is above 90%. I believe Israel is above 80%. India is somewhere between 70 and 80%. China is around 70%. Even the US, which, given its financial resources, should be in a much better position, is still somewhere between 60 and 70% fossil fuels. So there's a huge regional variance on this question in terms of how decarbonisation is going. Okay, so that's a very little bit of scene setting. The next thing I wanted to talk about, because it's essential to kind of lay this out in order to understand the arguments that I'm going to make later on, is to say something about how the world is actually going about trying to decarbonise electricity generation. So how is it doing that? And there's obviously an enormous amount one could say about that. But I'm going to focus on two particular things about that approach. One of which is to focus on the technological aspects of it. So how technologically are we trying to decarbonise electricity generation? And then the other one is the political economy of it. So how is that being done, or how are we trying to do it in political economic terms? Who are the actors? What are the institutions involved? Obviously, what I'm going to say is in both those senses are both big generalizations. So there are, I'm going to say things about the overall approach, and of course there are significant exceptions to both of those rules, and I'll point out some of them. But broadly speaking, these generalizations hold. So in terms of technology, and this I think will be obvious to many of you, if not most of you, the world is essentially betting the house on solar and wind. Now, that doesn't mean that there aren't countries where you see and will continue to see, for example, significant investment in nuclear, in hydro, in, for example, geothermal. Clearly, there are countries where that's the case. And I think it's also clearly the case that in the last 3 or 4 years, there's been a bit of a nuclear renaissance. Nuclear is being looked upon more favourably than it was maybe 7 or 8 years ago. There's more money going into nuclear now than many people had expected. Nevertheless, no credible energy forecaster is expecting there to be a really significant leap in nuclear's role in electricity generation. So today, nuclear accounts for somewhere between 9 and 10% of electricity generation globally. And nobody is expecting it even to get back to where it was at its peak in the mid-1990s, which was about 15%. So it might get back up to, say, 13%, maybe even 14%. But nuclear is not going to do the bulk of the work of replacing the 65% of global electricity generation that is currently fossil fuels. Solar and wind are absolutely being expected to do that. So solar and wind are going to, if the policies work out, do the bulk of that work of decarbonisation, combined with battery storage and things like that, which we can come back to later and talk about. So solar and wind is is where the focus is absolutely being placed, which is precisely why in what I talk about in what follows, I'm going to be focusing on solar and wind. So when I'm trying to explain why we are failing on electricity decarbonisation, I focus on solar and wind, not because I think that solar and wind is what we should be doing, but it's because what we are doing or what we are trying to do. So I talk about solar and wind. That's the first thing. The second thing to say is that just as we are kind of betting the farm on solar and wind, so too around the world, we are primarily relying on the private sector to undertake that decarbonisation. So what I mean by that is that for the most part around the world, what is not happening is government saying, we're going to do this ourselves. So for the most part, governments aren't saying, we are going to finance this, we're going to carry out the investment ourselves, and we're going to own and operate these assets as publicly owned resources. That is not what's happening. Now, there are exceptions to that. China is easily the most important exception to that, and I think it is an exception. So if you look at the Chinese case, something like in excess of 90% of solar and wind development and ownership of solar and wind assets is in the hand of state-owned enterprises, which are financed by state-owned financial institutions who borrow cheaply from a state-owned and run central bank, all of whom are operating very closely in conjunction and in response to what they are being told by Beijing and provincial authorities. So solar and wind development in China is a state-run, a state-directed project from top to bottom. That's not what's happening for the most part elsewhere in the world. So yes, elsewhere in the world, governments design and regulate electricity markets. Governments provide a range of different incentives, subsidies and other types of mechanisms to help incentivize the private sector to undertake renewables development, but the governments are not doing it themselves. They are basically turning to the private sector and saying, we expect you to do this. We will nudge you in the right direction through those incentives, but we're not going to do it ourselves. So this is just as this is a solar and wind focus, it's very much a private sector focus as well. Okay, and that both those things are very important to bear in mind. So the question of why it is that things are going much too slowly in terms of renewables development. The place I start in the book and the place I want to start today in talking about this is with what I think is the dominant, or kind of what you might call a hegemonic narrative that is out there in the world for why things are indeed going too slowly with renewables development. And interestingly, it's an argument that you hear from across the political spectrum, across the ideological spectrum. So this is not an argument that you hear exclusively from people on the left or from people on the right. You hear it from all sorts of commentators. And it's an argument that I'm convinced that all of you will have kind of heard or seen variants or snippets of in at some time or in some capacity. And the basic argument is that what is standing in the way of more rapid renewables development are a range of what you would describe as political or policy obstacles. So, for example, one thing that is often said is it takes much too long to get the necessary planning permission to get a new wind or solar farm approved and built and up and running. It takes much too long waiting in the queue to get a new solar or wind asset connected to the grid and able to marketize its electricity. NIMBY interests have much too much control over local planning processes and are able to stand in the way of the development of new solar and wind farms. Vested fossil fuel interests have much too much capacity to kind of kibosh new renewables developments, and so on and so forth. And so what all of those things share is the fact that they are of a political / policy nature. But an equally important part of that dominant narrative, I would argue, is that what the problem is not, or at least what the problem is said not to be, is of an economic nature. So to the extent that we can distinguish between political policy issues on the one hand and economic on the other, and I know that's a problematic distinction, but if you allow me that distinction for the sake of argument, what the problem is said not to be is of an economic nature. And it's worth just saying a little bit more about this. So what what people who make this argument say is that there was a time, not that long ago, when the economics were unfavorable to renewables development. So if you go back to, even as recently as the late 2000s, so about 15 years ago, it was clearly the case then that generating electricity from solar or wind resources was much more expensive than generating electricity by burning natural gas, or in particular coal, which was easily the cheapest way of generating electricity. And that was clearly the case. So you only have to look at some of the figures to see that it was much more expensive. The technologies were very immature. They were very expensive. Not much development had been done on them. And of course, ideological opponents of renewables made great hay of that economic uncompetitiveness. They said, look, it's so expensive. Why would we invest in that when it's much cheaper to simply carry on with coal and natural gas? And yet what happened, particularly from around 2010 onwards, and particularly in China, where much of the technological development and enhanced production efficiencies were concentrated, was that the cost of solar and wind power went down very, very far and very, very fast, particularly in the case of solar, such that by around the kind of mid-2010s, you had already reached the point in most places in the world that it was actually as cheap, if not cheaper, to generate electricity from solar and wind power than from burning coal, and certainly burning natural gas. And the argument then became, well, now that it's as cheap, if not cheaper, to generate electricity from solar and wind power, we've overcome that economic obstacle to renewables development. And therefore, it can only be the case that things that continue to hold renewables up are of a political/policy nature. It cannot be otherwise because, look, we've resolved the economic problem. And that discourse of kind of cheap renewables taking over the world has become a very, very common one over the last 10 or 15 years. This idea that if it weren't for those political or policy obstacles, renewables would rapidly supplant fossil fuels by virtue of their kind of incredible economic competitiveness. And so the basic argument of the book, and as I said earlier, there's a lot of kind of complex analysis in it, but actually the argument of the book is quite straightforward, I think. The argument of the book is that argument is wrong. That argument that the economics have been resolved is simply not true. And the book and the way the book goes about making that argument is to say that it is actually really misleading and not particularly informative to look at the economics of renewables through this kind of price lens, hence the title, The Price is Wrong, and that you see much more, and you see a much more meaningful and useful and illuminating picture if you look at renewables not through the prism of price, but through the prism of profitability. And what you actually find when you look at the profitability dynamics of renewables, what you actually find is that the renewables business is actually not a particularly attractive business. And I'll come back very, very shortly to what I mean by that. I know that's a very vague statement, not a particularly attractive business. There are significant profitability constraints associated with renewables. And just looping back to something I said earlier, that's obviously a problem if we are relying on the private sector to do this, because the private sector is nothing if not a collective of entities who operate largely, if not exclusively, on the basis of expected profitability. That's what drives investment in a capitalist economy, almost in its totality, is expected profitability. And if the expected profitability of renewables is not, as I'm going to suggest, is not sufficiently attractive, that private sector investment won't occur. And so that's the basic argument of the book, is that looking at it through the lens of profitability tells us much, much more. And what you find is that there are some really significant profitability constraints that continue to stand in the way of more rapid renewables development, despite the fact that those costs have come down as far as they have in the way I said earlier. And if that sounds counterintuitive, I'm more than happy to try and explain it later. I'll say something. I'll talk for 5 minutes or so about what I mean by those profitability constraints. I won't get into them in too much detail because I don't want to bore you. And as I said, I'm more than happy in questions to answer as much as you like about it. But before doing that, I just wanted to say one thing about what the business is that I'm talking about here. So what I'm talking about is renewables deployment. So what I mean by that is the business of developing a solar or wind farm, owning and operating it, and specifically selling the electricity that it generates over the course of its useful life, which might be 20 or 25, 30 years before the turbine needs to be replaced or the solar modules need to be replaced. It's the business of generating and selling electricity. That's what I'm talking about. So I'm not talking about manufacturing. I'm not talking about the business of manufacturing solar cells or modules or wind turbines. Now, of course, those businesses are connected. The profitability dynamics in manufacturing affect and are in turn affected by the profitability dynamics in deployment. And there are also some businesses around the world that kind of span the whole value chain. They do both the manufacturing and the deployment, although to be fair, most big businesses in solar or wind specialize in one or the other. There aren't many that are significantly active in both, but we can certainly analytically disentangle them. And I'm focusing on deployment, the business of owning and running solar and wind assets, not the manufacturing. Okay. So what do I mean by profitability constraints? What are these profitability obstacles? What the book argues is that there are essentially two separate but related obstacles, two really important things to think about, and I'll talk about those in turn. So the first of those is that in the business of renewables, in the absence, just to get this, I want to get it right. So in the absence of extrinsic mechanisms for stabilizing electricity pricing over the long term, and I'll come back to what some of the important of those mechanisms are. In the absence of those mechanisms, electricity price and profitability is incredibly volatile. At all time scales, from the very, very short to the very, very long. That volatility stems from the volatility of electricity pricing. And it's particularly notable in the types of liberalized electricity markets that have increasingly been put into place around the world in recent decades, not least in a place like Sweden. So Sweden has a liberalized electricity market. And I don't think I've ever come across a capitalist commodity where price is quite as volatile as it is with electricity. So the wholesale price of electricity, which is the price that the generator sells its electricity at to the companies that buy it and resell it to consumers, essentially, or to businesses, can literally go from 30 euros per megawatt hour to 3,000 euros per megawatt hour in the case of 10 minutes. And then half an hour later, it can be back at 30 euros. It's unbelievably volatile. It's very, very volatile at all time scales. And most importantly of all, that volatility is almost completely unpredictable. So it's never been the case that energy experts are able to reliably predict the course of electricity pricing 6 months ahead, let alone 6 years ahead. And that matters, particularly if you are a developer that's trying to raise financing for a solar or wind farm that might only pay off the initial investment over the course of 10 or 15 years. Okay, so I'll give you a hypothetical scenario to show why this is so important. So imagine you are a wind farm developer here in Sweden, and you want to, or anywhere in the world, doesn't matter where it is, and you want to develop a new wind farm. You want to save the planet, you want to do a good thing. Typically, the way in which developers raise finance is through borrowing. So normally, somewhere between 60 to 90% of the finance for a wind or solar facility will usually be debt rather than equity financing. So you would go to the bank, and there are lots of banks that specialize precisely in this type of energy finance. And you would say, look, I want to build this new wind farm. I need 100 million euros to build this new wind farm. will you lend me the money, please? And the banker will say, okay, I like doing good things for the planet as well. In theory, I'd like to lend you the money. If I lend you this money, how are you going to be able to pay the interest on the loan and then repay the loan when it falls due? And you'll say, okay, I will be able to pay the interest and repay the loan by selling electricity over the course of the life of the facility. And the banker will say, okay, what price are you going to sell the electricity at? And then you say, I have no idea. And the banker rightly will say, well, okay, here's the problem I have. The problem I have is that if you are able to sell your electricity at, say, an average price of 50 euros per megawatt hour for the next 10 years, then my maths show me that you will have no problem paying the interest each year and repaying the loan. Totally fine. But if it turns out that the average electricity price for the next 10 years is 15 euros per megawatt hour, or 20 even, there's no way you're going to be able to pay the interest, let alone repay the loan, and I'm going to lose my money. And so I'm sorry, because electricity pricing is so volatile, I can't lend you the money. And so the reality is that it's literally impossible, because of that volatility, it's literally impossible to develop a new wind or solar farm, to invest in renewables, unless, and this goes back to what I said earlier, unless there's an extrinsic mechanism for stabilizing electricity pricing over the long term. Now, historically, there have been two main sources of that stabilization. The first of those is governments. So because the governments want electricity to be fundable, they want developers to be able to raise finance from banks, what the governments have historically said is, okay, we will step in and we will provide that price stabilization. So what the government says is either directly or indirectly through various mechanisms that can be used, we will promise to buy, if you develop this new wind or solar farm, we will promise to buy your electricity at a fixed price for the next 12 to 15 years. And what happens then is the developer says, okay, great. And they take that promise from the government and they go back to the bank and they say, hey, Mr. or Mrs. Banker, now you can be confident in the price at which I'm going to sell my electricity. You know the government's not going to go bankrupt, so the government's still going to be able to buy the electricity in 12 years' time. Now you can give me the loan. And the banker says, fine, that's totally fine. The government's a credible counterparty. There you go. So that's the main one. And the main mechanism, which some of you might have heard of, is called a feed-in tariff. So a huge proportion of all of the renewable capacity that you see around the world when you're traveling around the world, solar power, wind power, has been financed with the help of a feed-in tariff. Well over 50% globally, has, probably well in excess of that. So feed-in tariffs, and there are a mechanism for enabling finance to be raised. That's the key thing to remember about them. The other one, and I'll mention the other main source, and I'll mention it because it's, again, something you're even more likely to have heard of, is where not the government, but a company like Amazon or Google or Microsoft comes along and says, okay, we've got this booming AI business where we need to build all these new data centers. We need a shitload of new electricity. We will promise to buy all your electricity if you develop a new solar or wind farm for the next 12 or 15 years, and we'll do it at a fixed price. And the developer doesn't care whether it's the government or Amazon, because from the perspective of the banker, Amazon is just as creditworthy as the government, right? The banker knows that Amazon's still going to be in business 12, 15 years and able to pay its electricity bill. So the banker says, I don't care if it's Amazon or the government, here's your money. And so that's that mechanism called a corporate power purchase agreement has become increasingly important. They've been around for about 10 years in the US, but they're becoming a big deal in Europe now, including in Scandinavia. It's nice and cold, which is what data centers want. There's lots of data center businesses being funded with the thanks of these corporate power purchase agreements. Amazon's the biggest buyer of them in the world. Okay, but if those mechanisms don't exist, you can't raise money. You can't develop solar and wind power. You need one of the two to mitigate that volatility. Okay, second problem is not the volatility of profitability, it's the level of profitability. And this problem is kind of even easier to articulate. And it's to say that the business of renewables deployment is a relatively low return, relatively low profit business. And that is obviously a problem, again, insofar as we are relying on the private sector to do this. And as I said, the private sector invests on the basis of attractive profit expectations. Now, I don't want to say too much about this, but I want to say a couple of things by focusing on the word relative. It's a relatively low profit business. And the reason I do that is hopefully an obvious one, which is that profitability is always a relative phenomenon from the business of a capitalist investor, right? If you are any capitalist actor, has a range of investment opportunities available to it, even if the alternative is simply leaving money in the bank or investing it in risk-free government financial securities like treasury bonds or whatever. So it's kind of meaningless to talk about profitability in an absolute sense. It's only meaningful to talk about it in a relative sense, and that's what I want to do. But to put some figures on this, most studies suggest that on average over time, and of course this varies, but on average over time, renewables, the renewables business generates returns measured as an internal rate of return. So that's the normal profitability metric that gets used, of around 5 to 8%. So nowhere in the world really has it been possible for renewables companies to generate returns substantially in excess of 5 to 8% for any meaningful length of time. So that's broadly what we're looking at, 5 to 8%. Now, just to focus on this relative question, I just want to give you two kind of counterpoints to those numbers because I think they're meaningful. So the first is to say that 5 to 7% looked a lot more attractive, say in the early 2010s when interest rates around the world were basically zero or close to zero, than it has in recent years when interest rates are 4, 5, 6%. Why, for example, to put it in very stylized terms, why would you go to the risk and the hassle of developing a wind or solar farm for returns of 5 or 6% if you can get the same amount as leaving money in your bank or putting it in treasury bills? So that's the first counterpoint. The macroeconomic context really, really matters. That's the first point. The second one, and this has become particularly clear, I think, in the last 18 months or so, is to compare that level of profitability with the level of returns that have been available for at least a decade now, to a very significant set of companies who policymakers around the world have been very much hoping would participate actively in the energy transition, if not necessarily leading it, which is big oil and gas companies. So if you are a BP or a Shell or an Equinor in the Norwegian case, or Total or Exxon, you haven't gotten out of bed in the last 10 years for expected returns in your core upstream oil and gas business of less than 15%. And typically they expect returns well in excess of 15% in order to greenlight a new upstream exploration and production project. So the question becomes, why willingly, of your own volition, would you plan to transition from a business generating returns of 15% plus to a business generating returns of less than half that amount? From a rational economic perspective, you simply would not do that. And that's precisely why, if you want to understand why the Exxons of this world have basically ignored renewables, it makes complete sense from an economic perspective. It's a much less profitable business. Now, of course, the caveat to that argument is that, and this is a bit of a tangent, but I want to get into it a little bit, is that you would, again, if you're focusing purely on economic returns, which of course those types of companies do, they are by their own reckoning required to do that in terms of fiduciary duty and all the rest of it, you would continue to ignore renewables and focus completely on oil and gas for as long as you continue to think that those above average returns will remain available in your existing business. Now, if you thought that governments were going to take the type of regulatory action in terms of things like carbon taxes that would impair the profitability of oil and gas in the medium term or even the long term, then potentially you would think, hang on a second, I can't stick with this business forever. I need to be thinking about transitioning. And I think that I think it's fairly clear that there was a moment in the 3 or 4 years after Paris when, at least in Europe, the big oil and gas companies thought that politicians were semi-serious about climate change, and that there would potentially be regulatory action forthcoming that would, in the medium term, certainly not in the short term, but in the medium term, as the vernacular has it, strand their assets, render those oil and gas reserves unburnable. But then, of course, what happened over the last 5 years is that governments have frankly shown they're not remotely serious about taking any of that regulatory action. They have continued to issue new licenses for new oil and gas field development everywhere in the world, kind of like confetti. They've showered those new licenses around the world. Norway alone, since 2021, has issued over 160 new oil and gas development licenses in the seas around Norway. And so, not surprisingly, the big oil and gas companies have said they're not remotely serious about taking action. There's nothing is being done that is going to impair that profitability in our existing business. And so what you've seen in the last 18 months is that those companies that did actually, about 5 years ago, talk a reasonably good game about transitioning, BP, Shell and Total, have said, fuck it, we're not going to do that. We're actually just going to go completely back to oil and gas, and we're not going to do that renewables thing. Because at the same time as they said they were going to do that, their share prices went down and down and down, while the Exxons and the Chevrons, who basically never even pretended to do anything about renewables, their share prices went up and up and up. And so now the kind of that profitability dynamic has kicked back in with full force, and they have just refocused completely on oil and gas because they know nothing is coming to jeopardize that profitability. So that was a bit of a tangent. But to make the simple point that all of this is relative. But as I said, profitability in the renewables business is relatively low. And if you look at the share prices of renewables companies in the last 4 or 5 years, they've just gone down and down and down and down as the realization has dawned that it's actually not a particularly attractive business. Okay, so I'm gonna talk for a maximum of another 10 minutes. So then we'll be broadly on time. And I want to just do 2 things in that time. I want to spend most of the time talking about potential kind of answers, solutions. And what I mean by that is to say, so insofar as the economic hurdles that I've been talking about today are recognized as being such, what do different people, different institutions suggest can be done about it? And it's worth saying that, there are plenty of people out there, plenty of institutions out there who are completely aware of those profitability constraints that I've been talking about. So of course they are. And one of the things that's been really interesting since the book came out about a year ago is being contacted by lots and lots of people, for example, within the energy industry, saying this is completely right. This is what we deal with on a daily basis. And so there's lots of people that knew this stuff, even if they don't necessarily articulate it in the way I have done today or in the book. So there's lots of people that are aware of this to one extent or another. So what do people suggest can be done to kind of overcome these economic obstacles and therefore hasten investment in renewables? And I want to talk about the kind of main suggestions that are in circulation. Not surprisingly, the types of suggestions that are out there vary depending on who you're listening to. Different constituencies suggest different answers depending on how they think about these things. So the first constituency that I think is worth listening to is what I would call, I guess what you would call energy economists, by which I mean economists working within the economics mainstream who focus specifically on energy questions. And there are some fantastic energy economists around internationally, and I personally I've learned a lot from them. Although again, they definitely wouldn't and don't think about things in the way that I've explained them today. And they basically say, look, there are two two ways to approach this, two ways to think about this. But I guess the thing that they share, those suggestions they have, is that they still share the belief that it's still right to focus on the private sector as the answer. Okay, so for those economists, capital is still the answer, but they think you need to do one or even both of two things. And I actually have some sympathy with both of these arguments. So the first argument is that they say is that this is a problem of market design. Now, what they mean by that is that what they say is the problem is that the types of markets through which we buy and sell electricity around the world today are markets that were designed in the context of and for a very different world than we have today. And they're right. So electricity markets as they exist around the world today, including in Sweden, are broadly unreformed since the 1990s. So they were put in place in what was essentially a fossil fuel world in most of the world. And so what economists say is we now have a very different supply mix, although the Swedish case would obviously be a bit different because there never was that significant fossil fuel presence. We now have a different supply mix. We need to optimize the market design. And if we get the market design right, everything else will fall into place. And as I say, I have a certain degree of sympathy with that argument. However, I also think it's very, very limited. And one of the reasons for saying that is that if you look at all the suggestions for alternative market designs that are out there, and there are plenty of economists who, make their living by selling or suggesting different market designs to policymakers, they all have their own drawbacks as well as potential upsides. There is no perfect market design, is the way I would put it. But that's the first answer, is that you tweak market design. And the other reason for being skeptical, I think, of it is that that's always economists' answer. The problem is never markets in the first place. The problem is that we haven't got the market design right. But the idea that there is a market design, a correct market design out there is the kind of almost the kind of foundational myth of economics as a policy-making proposition. So that's the first thing they say. Second thing they say, which I also have a degree of sympathy with, is the one that you'll be more familiar with, which is the argument that the reason that renewables continue to be uncompetitive has to do with the fact that fossil fuels generate a series of quote unquote costs, externalities, pollution that are unpriced. Right, it's the classic environmental economics argument that you need to put a price on carbon because the costs of carbon, the social costs of carbon, are unpriced currently. And I think that there's a lot of credit to that argument, at least theoretically to that argument as well. And indeed, I think there's quite a lot of evidence out there that you can do good things with carbon pricing, carbon taxes being one particular version of that. So, for example, the UK, as some of you might know, relatively recently managed to phase out its very last coal-fired power plant. Coal had long been a very significant source of electricity in the UK. The UK was recently able to phase out its last coal plants. There's no more coal-fired power generation in the UK. And one of the reasons it was able to do that is that it's had a very significant carbon tax, specifically on coal-fired power generation, for the last decade or so. And that tax has absolutely clearly helped make coal generation uncompetitive. So I think carbon taxes can do some work. I think the bigger problem with carbon taxes is a political one, right? Which is, again, I don't want to get into too much of a tangent, but we live around the world, but particularly in the global north, we live incredibly carbon intensive lifestyles for the most part, which means that if you start putting taxes on carbon, you start making daily life much more expensive. Inflation, right? And no government is willingly going to put in place policies that mean inflation for households, because that means they lose the vote at the next election. And that's what the last 18 months have shown again and again around the world. So the obstacles are much more political, I think, than economic. But anyway, that's what economists say. Second constituency is the energy industry itself. And people within the industry tend to agree with economists, of course, that the problem is not relying on the private sector. Of course, they would say that. But where they disagree is with the idea that you kind of need to change market design. They basically say, no, everything's fine. It's fine that we're relying on the private sector. It's fine that we're relying on markets to do this. The issue is we need more and better subsidy, essentially. They basically argue. They say, look, everywhere around the world today, although Sweden is a bit of an exception to this, there is significant subsidy to renewables generation, and there is. Most countries subsidize renewables. We just need more of it. Of course, and what they're implicitly saying rather than explicitly saying is we need more of it to boost profitability. And once you boost expected profitability, then the investment will flow in. And frankly, I have a degree of sympathy for that argument as well. Like, if you give me the choice, and if this is the only choice between, on the one hand, lots of subsidy, lots of investment in renewables, lots of profit for energy companies, or on the other hand, insufficient subsidy and no investment in renewables and therefore no profit, I'll take choice A every time, purely from the kind of climate perspective. Of course, the problem is politically that that's the choice we seem to be having right now, which is a very limited set of political choices, which brings me to the third sort of suggestion out there, which is the suggestion you hear much more from people on the left, I would say, without wanting to kind of, make it sound like too simplistic a political issue, which is to say, look, the problem is that we're relying on the private sector and markets to do this. We've been relying on private sector and markets to do this from the start. It's still not working, despite the fact that subsidy remains ubiquitous around the world, and despite the fact that the costs have come down as far as they have. Maybe it's time to try something else. And the something else that people typically point to is publicly owned energy generation, publicly owned renewables, where the government would borrow and invest and put on its own balance sheet solar and wind power on a significant scale, which, as I said earlier, is what China's doing. And I don't think it's coincidental that the one country in the world where renewables development is publicly owned and publicly developed is the one country in the world where investment has been increasing rapidly in recent years. I don't think that's coincidence. The one place in the world where it's not beholden to the profit motive is the one place where it's going fast. So that's what people on there say is more public ownership. And not surprisingly, maybe I have a lot of sympathy with that argument too, although I don't think it's necessarily the kind of silver bullet. I think public ownership and massive public investment in renewables is much more credible. In fact, is only really credible in rich parts of the world. If you're talking about countries in the global south whose governments are already operating under enormous fiscal constraints, economies that are laboring under massive legacies of debt repayment already, the idea that they're going to kind of engage in a big green state to undertake public renewables investment, I think is pretty far-fetched right now. But certainly in a place like Sweden or the UK or Germany or the US, despite the fact that politicians have kind of persuaded themselves or allowed themselves to be persuaded that the fiscal constraints that they're operating under are pretty real, they're not that real. And just the fact that Germany's been able to just say, oh, we'll just add an extra 200 billion for defense spending, just like that, shows that those kind of fiscal straitjackets that governments put themselves in are self-imposed rather than externally imposed to a significant extent. But that's much more true in the global north than it is in the global south. Okay, so that's the third answer that people talk about. Okay, 2 more minutes, then I'm done. And the last thing I wanted to say is just kind of is to pivot back to something I was mentioning earlier, which is the point about the fact that all of this is very, very geographically differentiated, very, very different in different parts of the world. And it's to make what I think is a relatively uncontroversial, relatively simple point, but which I think often we forget. And by we, I mean people like myself who work in Europe, think a lot about Europe, North America, and in my case tend to think much less about other parts of the world, which is the point that increasingly the whole game when it comes to kind of decarbonisation is actually not what's going on in Europe or even in North America. Frankly, it's what happens in other parts of the world, and there are two reasons for that, which are which are important to kind of lay out. And what I mean by this is that it's in other parts of the world that the what happens or doesn't happen in terms, what happens or doesn't happen in terms of decarbonisation will be much more consequential for the future of planetary emissions. The two reasons for that are firstly, which is that on average today, the electricity sectors of countries in the global south are substantially more fossil fuel intensive than the electricity sectors in countries in the global north. I think there are very good, historical, political, economic reasons for that are completely explicable. But it's nonetheless the case that they are generally more fossil fuel intensive. You need to look at India, Nigeria, South Africa, in fact, most countries across Southeast Asia, Pakistan, Bangladesh, Indonesia, to see that in the data. And then secondly, and just as importantly, for all the kind of hoopla around AI, almost all energy forecasts globally suggest that the bulk of future growth in energy production and consumption will be disproportionately located in those same parts of the world, with ongoing urbanization, modernization, industrialization, and indeed just energy access for hundreds of millions of households that haven't even had electricity hooked up in the past. You put those two things together, greater fossil fuel intensiveness today, greater future growth in electricity demand and production, and it becomes patently clear that while, of course, it's really important what happens in Europe and North America, what happens or doesn't happen in other parts of the world will make the much bigger difference in terms of future global greenhouse gas emissions trajectories. And so the very last thing I'll say is that the kind of dilemma I think we have globally now is that it's precisely in those parts of the world where most needs to be done in terms of future investment in renewables that the economic and financial challenges of the kind that I've been talking about today are greatest to that investment occurring. Not least, but not least, because raising finance to get renewables projects off the ground is so much more expensive in the global south than it is in the global north, which means that it's that development is simply not occurring because of those financial and economic obstacles. And I think that's the real challenge that the world has right now, is that it's a million miles from coming up with credible solutions to how that investment that's necessary across the global south is going to be undertaken. And I'm done. So thank you. And I'm happy to any types of questions, whether they're like, what the heck were you talking about there, or as long as they're not too difficult.
Yes. Should we start here? And Harald, you tell me if they're online.
My name is Frederick. Okay, so I have a question regarding the tariffs that you mentioned.
Yes.
What kind of effect do they have in inflation terms compared to other tariffs?
Can you be a bit more specific about what you mean by that?
Because I have heard about other tariffs that Trump is talking about.
Okay.
For example.
So it's different type of tariffs we're talking about here. So
exactly.
So those are the tariffs that are in the news at the moment are trade tariffs, right? And so they are all about making products coming from abroad more expensive in order, in theory at least, in order to increase the competitiveness of local industry. And they can have an inflationary impact, right? If you're increasing the cost of goods that households are ultimately buying. The tariffs we're talking about here, maybe the tariff is a misleading word for it. Basically, it's a mechanism for fixing the price of a product that households will be buying indirectly, if not directly, going into the future. Now, of course, if those fixed price electricity contracts are priced at a higher level than they arguably need to be in order to incentivize that investment, then you're going to have an inflationary impact. But one of the really interesting things, and this kind of goes to the heart of the argument in the book, is that they are awarded, the way in which they are awarded is on a very kind of competitive basis, which tends to strip out any potential inflationary impact. They use they normally, the way in which they're rewarded now is through these reverse auction processes, where actually renewables developers bid prices down against each other rather than up, down to the point at which they perceive the profit to be marginal, and at which point they won't go any lower in terms of pricing. So I don't think there's been any inflationary impact really from those types of tariffs. So different type of tariffs. Yeah, but good question.
Yeah. From you.
Yeah.
Yeah, thanks so much. One thing which would interest me is the question of scarcity, then also how this plays in, because isn't implicitly in how kind of the imagination of electrification is that there is more or less infinite supply. So it's a problem of technical and social engineering. So in principle we could, even if you just look at how many offshore wind power projects are prospected in Sweden, this would already more or less be as much as electricity as we use now. And this idea somehow drives also this process of electrification somehow, doesn't it? And comes in conflict then with questions of profitability.
Mm-hmm.
So I'm just wondering how much this plays into the economics, because isn't there also, and I heard at least, sometimes then discussions even from the utility side, because in principle, implicitly, if the supply would be infinite, if this wouldn't be a problem any longer, the price would not work.
Yeah.
I mean, if you have more supply than demand, then
Yeah.
basically you are even in negative prices or zero,
Yep.
which you already see sometimes. And there sometimes are discussions then about flat tariffs, for example, so that you have which is in principle also a question of market design, but that you have a totally different economic model. It's like in the mobile phone industry, where basically the data itself don't cost a lot, but you pay for how much the download speed in the end. And in the end, in the electricity, you would pay for the capacity which you can get.
Yep.
Is this something which it looks very far-fetched and very absurd and against anything, which we discussed then about in terms of finiteness of resources and everything. But is this something, these types of also different economics models which come up sometimes?
Yeah, no, absolutely. Yeah. I mean, I think that the telecoms analogy is one that it does come up, although not, I think it's so far away from being possible economically and or technologically right now that it's never on the kind of main menu of potential alternative market models, but you do hear about it. Yeah, I mean, absolutely. I mean, it's hard to give a simple answer because that was quite a wide-ranging question. But of course, one of the interesting things about electricity, right, is that supply must always match demand at all times, because otherwise the grid blows up in one way or another, particularly if the demand is excess. And so the job of the grid operator is an incredibly complicated one, which is to make sure that there's always sufficient supply coming onto the grid at any moment of the day in order to meet the demand that is on the other side of the grid. Now, one of the things that means is that there will always be excess capacity in general within the system, because you have to have that excess capacity in order that at peak times you can meet the demand that's there. So there's always lots of generators that are not, at least except in peak times, that are not generating. And the implications of that for the planning of investment in new capacity is very, very complicated. So for example, some, but not all, places in the world have what are called capacity markets as well as energy markets. And what happens in capacity, and what that means is that basically some generators, particularly gas and nuclear generators, get paid not just for the electricity that they generate, but for being available to generate on call. In other words, having available capacity, because it's realized that if they didn't have those payments, then they would have to shut down because they're not operating often enough in order to be economically viable. So all of this is incredibly complicated. And you're right, absolutely right, that one of the implications of all of this has been that at times when there is excess capacity on the system compared to demand, prices get forced down to the point of being negative. And the only reason they can go negative is that some generators are in the receipt of a subsidy, and that subsidy is sufficiently large to offset the impact of next, so they can bid at negative prices and still make a profit. And here's the thing, right? Which is, and in the industry and in the literature on this, it's referred to as price cannibalization. And the issue you get is that the more renewables there are within any electricity system, the more that has a depressive impact upon pricing, and the more that disincentivizes further investment in renewables, right? So the renewables have this kind of unfortunate characteristic of cannibalizing the conditions for future investment in new renewables capacity. So it's really, really complicated. And so one of the things I've learned to my cost in doing this work is that electricity really requires you to understand the engineering side of it as well as the economic side of it, because they're fundamentally interrelated with one another. And so, for example, like what do you do if a renewables company can produce on a really windy day, if they can produce loads of wind power, but there isn't the demand for that wind power at that moment because it's 11 o'clock in the morning and it's warm and no one's watching TV and no one's cooking, and B, there isn't yet the capacity to store that excess electricity through battery or whatever other technology until such a time that there is demand. What do? Do you just tell renewables companies that electricity is going to be wasted? In most countries of the world, no. In most countries of the world, renewables generators get paid even for electricity that they can't sell. It's called curtailment, and in some parts of the world, there's been so much excess investment in renewables that in parts of China a few years ago, upwards of 20 or 30% of electricity of renewable power was being curtailed, wasted, but they were still being paid for it. And so I think in the UK last year, I think renewables generators were paid something like £700 million for power that wasn't even being sold. It was just wasted. So it's really complex, but also really, really interesting. And trying to get your head around how you develop incentives for decarbonised investment is very, very complicated. It's not straightforward. Don't know if that answered your question, but that's the best I can do.
I can also speak.
Yeah, I can.
Hi, my name is Andre. Sorry, I might have missed something, but I was wondering how dependent is this price volatility due to these energy sources being weather dependent? And also, have you stumbled upon or made an estimate of how the profitability would be lower if the miners that are employed weren't exploited or, slaves, basically? How would that impact the market in profitability?
Yeah. So I don't have an answer to the second question. In the first one, which to generalize the question's about what explains that volatility, and I didn't explain it at all. You're right. So that price volatility comes from lots of different sources, one of which is the intermittency, variability that you talk about, right? If it's, as I said in answer to that question, if you have at one moment, masses of electricity available and very low demand, and the next moment, the opposite, of course, you're going to get volatility. But it also has a lot to do with the way in which electricity is priced in the types of markets through electricity is normally bought and sold now around the world. And it's worth saying a little bit about that because not least because it became became a huge issue during the energy crisis in Europe in 2021, 2022. So it's actually quite interesting. Well, I think so, but I'm a bit of a nerd on these things, how it's priced. So basically what happens within liberalized markets like Sweden's, but also the UK, most of the US, Canada, most of South America, other places, is that basically the grid operator, as I said, has to make sure there's enough supply to meet demand at every moment. What they basically do is they say, okay, for each half hour during the day, I'm gonna have my estimate of how much demand there's going to be, and I'm going to make sure I have enough supply from different suppliers of electricity to meet that demand. And of course, at the actual moment, there has to be a balancing mechanism, because companies like renewables can't completely accurately predict how much power they're going to be able to produce because of that variability. But for the sake of argument, let's assume they can. So what happens is, for each half-hour period, every generating company makes a bid to the grid operator. Says, okay, I can produce this much power for that half hour, and my bid price is this. This is the price at which I'm willing to sell the power to you. Okay. The grid operator then takes all those bids and it puts them in a stack. That's what it's actually called. And it puts them in a stack, and it puts the lowest price bids at the bottom. And then it goes up the stack. And what you find is that almost always the lowest price bids are from renewables generators. And then you go up the stack, and then you kind of, in a really diverse system like America, you have the renewables at the bottom, then you have coal, then you have natural gas, and then nuclear is always the most expensive. Okay. And basically what the operator does is it goes up the stack as far as it needs to go until the cumulative supply meets the cumulative demand. Now, during a very windy moment when demand is low, it won't have to go very high up the stack because there's lots of wind power, not much demand. And so it only has to rely on wind generators for sufficient supply. In the opposite conditions, when it's like freezing cold in America, everyone's got their electricity on, it's the middle of the night, so there's no solar, the wind's not blowing, they have to go all the way up to the top of the stack. Every electricity generator that can produce power, they rely upon to do that, including the most expensive. Now, here's the crucial thing, is that everyone who supplies electricity in a particular half hour doesn't get paid the price they bid. They get paid, everyone gets the same price, which is the highest price bid that was necessary to meet the cumulative demand. Now, what that means is that in those former moments, the market price is very, very low because it's just wind generators. But in the other situation, when it's everyone's having to produce, everyone gets paid the price that the nuclear generator bid. So you can go from all the wind generators, which might be 10 euros per megawatt hour, to nuclear, which could be 200 euros or 300 euros per megawatt hour half an hour later. So that's the prime determinant of volatility, is the swing in what the so-called marginal unit of supply is, the last supply units that's necessary to provide the cumulative demand. And what happened during the energy crisis in Europe in 2021-22 was that natural gas prices went from down on the floor to up there. So in those moments when gas was setting the market price of electricity prices went through the roof, even though it was possible that gas was only supplying 2% of overall electricity. It was setting the price for 100% of the electricity on the market. Does that make sense? It's really, and one of the arguments is that makes no sense as a way of price. Why should everyone get the same price? But that's the way it's always been done. And the reason it hasn't been changed goes back to your question, which is price cannibalization. If you start paying renewables generators the price they bid rather than the price that, the fact that they can sometimes get the gas price for their electricity is what incentivizes them essentially to invest in renewables in the first place. You take away that incentive, then they won't invest in it in the first place. So a lot of it's about the way in which market pricing occurs.
Okay, I have a distribution question as well, and it's on if the scale of the energy market matters in this question. In the 19th in Sweden, you had like the formation of Nord Pool, and then you later have an expansion of the grid into EU and an integrated energy market. And if does that matter for price volatility and in extension profitability?
It's a really good question. So you're right that electricity is now increasingly traded across geographic borders in the way that it wasn't historically. And Nord Pool, the operator, covers the whole of Europe. However, pricing still occurs pricing itself still occurs specifically within countries. And then in different countries, you have different ways of doing that. So in the UK, for example, there's just one national price. Sweden has regional pricing. So you have 4 zones for electricity pricing, and you often get very, very different prices of electricity in different zones within Sweden. My best guess is that has diminished volatility somewhat, but only marginally. And I think, one of the reasons for that is that the interconnectors between the different regions are still quite limited, including within Sweden itself, right? I mean, that's the big reason why, electricity can be 100 euros per megawatt hour in Stockholm in the southern region of Sweden, and 5 euros or 1 euro per megawatt hour in the north, is because of the inability of those interconnectors to equalize the price within regions. They're still relatively limited, let alone between countries. So it's a really good question. My guess is that there's academic research on that, because there's academic research on everything. But I don't know of it myself. But my best guess would be that it's had some impact on volatility. And the other interesting thing, right, is battery development. Batteries are the big hope for diminishing that volatility, and for therefore militating the negative impact of that volatility on the ability to raise new investment. Whether batteries will have that effect, we don't know yet, but it's one of the great hopes within the industry, is that the more battery development you get, the more storage capacity you have, that volatility will diminish. Yeah.
Then we have a question online. Will you read it, Harald?
Or ask. Just there, but still, isn't the electricity price which you pay, that's the same on the North Pole for everybody? It's just the grid tariffs which then differentiate between these zones. So basically, so they then actually make this differentiation.
Yeah.
Then again.
Yeah.
So we have a question, and I'll try whether this works. Lucas Slothus, whether you can ask directly. Wait, I'll try to open up. So Lucas, can you try to ask?
Hello, yes. Sorry, it's a bit noisy here. I don't know if you can hear me.
We can,
Yes,
yeah.
we can.
Great. Okay, perfect. Thank you so much, first of all, for the talk and for the book as well. I'm really interested and very influenced by your work and your thinking. So thank you so much, and thanks to the organizers. My question, maybe, I don't know if this is a kind of stupid or crazy question.
Probably not.
But do you think, to put it polemically, that yes, the price is wrong, but is that because the price mechanism itself, or to begin with, is actually wrong as well? I.e. that it's not just about finding a better price, but that the problem is pricing in the first place. In other words, could the solution be a decommodified energy system where you don't just have state-owned utilities where the state either subsidizes or actually controls energy production, but a system where you don't have a price at all, so you could sort of decommodify, de-price the system, centrally planned, some kind of smart rationing where the state sets certain kind of plans for what energy will be produced and where it will be distributed to and who will consume it, that moves towards some kind of gradual reduction of total energy use. Thank you.
Yeah, no, nice small question. I mean, I guess my answer to that would be the answer that I often kind of fall back on in response to questions like that, which I think are really good questions, and it's going to be a very unsatisfactory answer, and it's basically to say that in theory, absolutely. I mean, I think that the kind of very, very different approach that you outline has a lot to say for it. I do think that market mechanisms and the price mechanism are sometimes useful. I do think that they can markets can play a relatively positive role in certain contexts and for certain types of commodities. But I think electricity is one that where that role is very ambiguous. I think that some way of that any kind of decommodified system would obviously have to have all sorts of different checks and balances in order to kind of constrain consumption for environmental reasons in the way that for certain types of consumers the price mechanism currently does. But I think the bigger obstacles to that, and the reason I personally never don't tend to spend much time thinking about it, is it seems so far-fetched politically, given where we're at politically today, that it just seems, sadly, it seems kind of unimaginable to me that anything like that would happen even within my lifetime, which I know is a very kind of unsatisfactory answer, but that's kind of where I'm at, which is that, yes, in theory, but in practice, I spend much more time thinking about stuff that feels kind of, politically challenging, but at least politically kind of possible. And I'm by no means, to connect to what you were saying about public ownership, I'm by no means a kind of an unalloyed enthusiast necessarily for public ownership. I think public ownership of energy, like any other type of commodity, can be good and bad, just as private ownership can be good and bad, although with the emphasis there on the bad when it comes to energy. I think about someone like Norway, for example, where most energy ownership is within the hands of companies like Equinor and Statkraft and so on, which essentially just act in exactly the same way as private operators. So I think I wouldn't ever romanticize public ownership, but at least I think public ownership of an energy like commodity that would still be bought and sold on the basis of pricing and market through market or quasi-market mechanisms seems reasonably credible. But unfortunately, a more decommodified system, which in theory sounds very, very attractive, strikes me as so far-fetched right now that I personally haven't given it much thought.
And one more question here from Lola Nake, who would ask, do you know why the dynamics of offshore wind auctions differ from other renewables auctions? For example, in Germany, auctions for onshore wind have not led to a huge decrease of tariff levels, but auctions for offshore wind receive 0-cent bids, i.e. the developers asking for no government support, and developers now offer money to win the right to build offshore wind power. Is that there is a scarcity of available land, or is offshore wind more profitable than other renewables?
It's a good question. I don't know the German case specifically. What I would say is that there has been a transition across most of Europe over time towards auction type mechanisms. So in many parts of Europe, including I think Germany, auction mechanisms for awarding those contracts and the associated tariffs are relatively recent, which means that they are most notable on offshore wind because there has been a shift towards offshore rather than onshore wind. So it may well be the case that there are different mechanisms of award for onshore versus offshore in the specifically in the German context. I think the other thing that's really important to understand, and I don't know whether this is true in Germany, but it's certainly true in places like the Netherlands and Denmark and others, is that what are often described both by policymakers and by the industry itself as subsidy-free renewables projects almost never are subsidy-free renewables projects. So there might be cases where projects get awarded on the basis of contracts that are not themselves subsidized, but what you always find is that subsidy is being provided in other ways, like, for example, free grid connections, free leases to seabed and things like that. And so it becomes very difficult to compare and contrast projects and their economics, even within specific countries, comparing, for example, on and offshore wind, let alone across different national environments. But that may be the case.
Thank you. So I was wondering, essentially, if capitalism is not the answer here, and we see that much of the development coming that will have a big impact on the climate crisis and the environment will be in the global south. And we see that the global south will have an especially hard problem with doing this kind of alternative of public funding. How can we, what kind of alternatives are there that will not end up in some kind of Malthusian narrative where it will instead be not everyone deserves to live at a certain level of welfare or so.
Yeah.
I don't know if that's what you set out to do, but in any way that there is alternatives for some kind of global environmental governance at this point. Do you have any thoughts on that?
Yeah, let me say, I mean, a couple of things in response to that. One relatively tangible and one a bit more kind of speculative and out there. So I think it's worth saying a little bit about, on the tangible one, a little bit about how renewables projects that do get developed in parts of the world where governments are very under enormous amount of fiscal constraint, how they, because they do sometimes happen, and basically the way they happen right now is through some form of kind of quasi state finance. So the typical. So for example, if you want to develop a renewables project in, say, Namibia or Senegal, for example, or Vietnam would be another example where there's quite a lot of development occurring. If you go to a private bank, a commercial bank, and say, I want to borrow money to do this, they will typically say, okay, the interest rate's going to be 12%. Whereas if you did it in Sweden or the Netherlands, they would say the interest rate's 4%. Now, the reason that happens is not necessarily because the risk of the loan is greater in those countries. It's because the perceived risk is greater, and it's all about risk. It's all about risk perception. So the actual risk kind of doesn't matter at the moment of the loan. It's all about how risky they perceive that loan to be, and they, rightly or wrongly, they perceive the risk to be greater, so they charge a greater amount. What that means is that there's no way that a developer is going to be able to commercially develop that project at 12% interest. Can't do it. So the only time it happens is when an entity like the World Bank or a philanthropic institution or the Asian Development Bank comes in and says, okay, you can't do it at those commercial interest rates. We will provide essentially subsidized finance, either instead of that private finance or in conjunction with it, so-called blended finance, in order to reduce the cost of the debt to a point at which you can make a fist of things viably at that lower cost of finance. But the problem right now, of course, is that there's only so much finance available from the World Banks and so on. They don't have unlimited, and they have all sorts of other financing requests as well as renewable energy, right? And so, it's hardly scratching the surface of the demand there is for that type of financing. And it's worth also connecting that to the annual COP conferences that take place when all everyone gets together and says we need to start, and then the developing nations say we need a shitload of money to do this, but we can't afford, and the developed countries say no, basically, because it's hard enough to in places like the UK or Germany or the US, politicians have a hard enough time persuading electorates that they should spend money on developing renewables in their own countries, let alone on the other side of the world. So that's the first thing to say about is how it's happening. I think the second thing to say about, in terms of kind of what you were saying about kind of Malthusian prospects and what happens once the temperatures get higher, is that there's lots of really interesting work in political theory, some of which you might be aware of, which kind of speculates about those questions and says, what can we expect to happen politically once we hit 3-4 degrees and once the shit really starts hitting the fan? And it's worth reading a lot of that. Does it mean that we would expect to ultimately see some form of global government? Because only a global government could kind of overcome those collective action problems that currently bedevil the climate agenda. Is that what we would expect to see? And because only that type of government could take the action that will be necessary to prevent things getting from 4 degrees to 5 degrees. I have no idea, but there is a lot of interesting work being done along those lines. There's a great book called Climate Leviathan, which is really worth checking out, that is exactly trying to approach that question of will the existing global political economy, which is kind of capitalism and nations and independent nation states, is that what it's going to look like in 50 years' time in a climate stressed future? It's by no means inevitable that it will be.
Hi.
Hey.
You hear me?
Yeah.
My name is Gunilla. So, thank you for your presentation and your book and so on. If we imagine there are two ways, so we have the market regulation way, and then we have on the other side the financing, and like you could, subsidize. You can regulate that there will be financing for certain projects, and you can try to regulate there will not be financing for fossil fuel projects. So, politically, so in this market way, I see, it's always like that. If we have liberalized the markets, it will be difficult to go back this way. Still, on the bank and the financing side, there's a lot of private finance, but still the private banks, we have some political control still. The European Central Bank, and we also have state loans. There can also be on a local level, the local municipal can have funds for renewable projects and so on.
Yep.
But so my question is more, if we go on, I know we're in hard times and so on, but maybe with some idea of the wars coming along or something, there will be enough political support to regulate private banks through European Central Bank, state loans, local loans. But will that be enough if we don't?
It's a really good question. Right. So the way I would answer that question is to say that it's really interesting that in kind of popular and particularly political discourse about climate, it's often compared to a war, right? It's often that imagery is often marshaled. And of course, one of the most interesting things about wartime economies is that that's what governments do. They compel capitalist actors to do certain things, to produce certain things for, the national war machine or whatever else it is. But right now, thus far, there has been, in relation to climate, governments have not, at least if you exclude China, governments have not wanted to go down that road. They've not wanted to, it's all been about incentivization rather than compulsion. And there's very little conditionality, for example, even conditionality imposed on what companies and financiers are doing. But one would imagine that might be the next step. But again, coming back to the kind of the politics of the moment, the idea that you would tell firms what to do is pretty beyond the pale right now. But of course, in the past, that's happened all the time. It happened, in the finance sector in the UK until as late as the 1970s in terms of where they were able and required to channel credit and so on. So it's not that far ago, but because of the kind of ideological developments of recent decades, essentially neoliberalism and freedom for capital to flow wherever it wants to flow, that feels like it's quite a long way, despite the resurgence of industrial policy and so on, still feels that form of kind of constraint and compulsion is a long way off. But I think that would be the next step.
Many thanks for this, Brett. So you mentioned the energy economists and their proposals that you don't find particularly viable. But I wonder if you could say a little bit more about these proposals for market design. What are they proposing, or what are the proposals? Is it mainly about carbon taxes, or is there something else? And is there something in there that you think is more viable than anything else? Or yeah.
Well, for example, one of the I suppose probably the most common and most often discussed proposal for market design in terms of electricity markets is this idea that you basically split the market up, and so you have different prices for renewables and different prices for fossil fuel based electricity, because of, you know, going back to my answer to the question down here, because of this kind of seemingly perverse way in which electricity is priced right now, which is that even if you are able to sell your electricity at a very low price, there are moments when you get a very high price because everyone gets the same market price. And so during the electricity crisis of 21-22, there was enormous enthusiasm for undertaking that type of market redesign, because household energy prices spiked, and people learned for the first time about the fact that electricity prices so closely tracked gas prices, and people were like, well, that makes no sense at all, given the fact that gas is only supplying, you know, even in the British case, 30 or 40% of electricity, but it sets the market price like 95% of the time. And everyone said, we need to uncouple gas and electricity prices. But what's happened, and this gets to the question of what I think the limitations of that proposal are, is that as soon as prices went back down, household energy prices went, everyone forgot about that prospect of decoupling, because, as I said earlier, that link to gas pricing is in a sense a key incentive to keep renewables companies interested in investing in new capacity, because you break that link, then suddenly the price at which you can potentially sell your electricity falls to rock bottom, and you think, well, it's going to become even less profitable than it currently is. So the way I like to think about this in a much more, which hopefully answers your question as well, in a more kind of general sense, is this, which is that governments right now across Europe, not just across Europe, but in those countries in the world where they're trying to hasten electricity decarbonisation, they want two things, okay? They want the energy transition, the transition to renewables, to happen at lowest possible cost to households. It's completely, and they've, not only do they want that, they've said that's going to happen. We're going to decarbonise and it's not going to cost you a thing. Your bills will stay the same. On the other hand, however, they want the private sector to undertake that investment, and therefore they also want, although they don't say it, they also want that investment to be sufficiently profitable for the investors in the generating capacity that the investment will occur. The problem, of course, that they face is those two things are completely contradictory to one another. It's very, very difficult to enable the producer of a product to make a shitload of money out of it while keeping the cost of the product incredibly low. So policymakers are constantly trying to kind of thread the needle between these two opposing imperatives that they're operating under, and they kind of swing a little bit back and forth between them unconsciously, I would say, for the most part, in how they're trying to get. It's very, very difficult to get those two things to meet with one another.
Maybe I can also ask about the Swedish experience with wind power, because we never had any feed-in tariffs in Sweden, and still we have had quite a lot of wind power expansions.
Yeah,
and from what I know, these kind of power purchase agreements with Facebook and Amazon are quite a new thing in Sweden, at least.
Yeah.
So what were the economics 10 years ago? That has something changed, or what was driving the?
Yeah, so Sweden is relatively unique in not having the feed-in tariffs. I think, you know, it did have a different type of incentive mechanism, the renewable energy certificates, but it's questionable how significant that has been. I think that one of the big differences has been land costs. Most of the development has been very far up at north in Sweden, and land's been very, very cheap. Which in other countries, that's, if not the main cost, then one of the most significant costs. That's made a massive difference in the Swedish case. So I think that's been significant, and I think the reality is that it's proven pretty disappointing for most investors, actually, which is why very little investment has been occurring in recent years. Without those subsidies, I think the investment proved pretty disappointing for most of the major investors. There's been some studies done that look at the profitability of the Swedish wind sector, and there's been a lot of loss-making entities, actually. And so I think that's been quite an interesting experience for other countries to look at, and has kind of reaffirmed them in their belief that basically the price and revenue guarantees are pretty necessary, partly because of what the Swedish experience shows. But it is relatively unique in that sense.
But so you think that's an actual experience that banks have made, for example, that profitability is low?
Yeah, absolutely. Yeah, no, absolutely. Swedish has been an incredibly disappointing experience for renewables investors, and particularly their financiers. Yeah.
Maybe this will have to be the final question. Do we have anything online? No?
So thanks a lot.
I can hear you fine.
Yeah. So thanks a lot for your presentation. So my question is that the future competitiveness of the European industry also depends on the access to low cost energy, but the prices now have gone quite high. And then what we also see is, like example, China and other countries are taking over the new critical industries like electric vehicles, and the USA has a lot of subsidies for this battery. So the European industries is now in a big challenge, actually, that they are losing the competitiveness, but the energy prices are also going high. So how do you see these developments in the future?
Yeah, that's that's much of that question is what is well beyond my competence, given that it that question expands well beyond the specific question of renewables development. But I think that it clearly is a really challenging moment for European industry, as you say, both in terms of energy pricing, also with Northvolt being the most obvious example in terms of European companies being able to develop a significant competitive position on the manufacturing part of the supply chain. I think it's a very, very challenging moment, and I don't think it's obvious what the answers are to that at all. And I think that I don't think the US is in a much better position. I mean, energy prices are lower. I think that's the one area where American industry is at a significant advantage. But in terms of kind of the clean tech supply chain aspect of it, I think America is just as far behind China and the rest of Southeast Asia as Europe is, frankly. So I think on the energy price front, there's a difference, and it's difficult to see that changing anytime soon. Yeah, I don't really have much more to say than that. I mean, it's a really big question, which I think in the next few years there's going to be lots of work being done on those questions. Yeah.
Thanks a lot, Brett, for a really great talk.